Good afternoon. Happy Friday. This is Sean LaBelle of the Dekker Hewett Group. Markets were marginally lower here this week, also wrapping up the first negative quarter that we've seen in exactly 2 years. Of course, navigating markets the last 3 months has been quite challenging for investors as we do deal with inflationary concerns, rising rates, and of course, the situation in Eastern Europe. Hence why we did see the S&P 500 finish down around 5% for the quarter. That is considerably better, though, than the 12% that we did see, that low sort of mid-March level. We were able to recoup quite a bit of those gains last week, as we've been kind of telling everyone that the fundamental backdrop, while slowing, is still positive, right? And this has been our message to investors the last 3-4 months, is we are going to see a pickup in volatility, which is naturally has been the case. But we are going to see a growing environment. Companies are still generating decent amount of profits as they're able to pass along inflationary concerns to consumers. The consumer is in a very good condition right now with historically high savings. You're also seeing a very good labor market. This is probably the tightest labor market that we've seen in maybe 50, 60 years. It's basically running at full employment. So this is not a recessionary environment, as we talked to in this week's Market Watch Weekly. It's also our Q1 wrap. So it just discusses how our discretionary portfolio has performed, which was good. As we've been kind of telling you guys for the last few months, we have tilted towards those value-oriented names, expecting that pickup in volatility, which we did get. We did finish the Q1 on a positive note and relatively close to record highs. We did get a little bit back yesterday afternoon, but our portfolios are still in the green for the year, which is a pretty good feat, as I mentioned, considering the S&P 500 is down around 5-6%. So what to expect going forward? We do expect continued volatility, but perhaps a little bit less so. We've had the bulk of that now that the Federal Reserve has increased interest rates for that first 25 basis point rate hike witnessed in the beginning of March. We expect things to calm down a little bit, but it's still going to be more erratic than what you've become accustomed to the probably last 18 months or so. This is just a normal trading environment. Again, as we've been kind of alluding to, the last 2 years have been quite tranquil aside from that COVID-19 sell-off. But we remain constructive. Again, U.s Gdp is growing above trend around 2.8%. That's better than the 2% that we've witnessed the last 2 decades. And again, unemployment is near historic lows. So these are all reasons to remain optimistic on the market, which we remain bullish for the balance of the year. Hope everyone enjoys the weekend, and we will talk to you again next week. Cheers.